Hello, I'm Matt Kaiser from Financial Science and Art, and we're just getting our YouTube channel going, so this is one of our first videos. I think it'll take us a little bit of time to figure it all out, but we're excited about the new venture, and we want to get into it. So let's talk about the topic of the day, and it's about the markets going down for the most part this last week. It's been a pretty rough week, and we believe that there could be more to come, and more likely more to come. So we're treading pretty thinly. We went to some cash in our accounts. We're advising our institutional accounts to tread lightly and not buy on this dip. There will be a time to buy for sure. But for the time being, we think the probability is to the downside, or the risk is to the downside. Okay, so I want you to have a look at a clip from when I was on BNN on December 21st, 2017. So have a look at that.
Thanks for having me.
You reckon right now you're reluctantly bullish on the market. I love that.
Yeah, I don't think I've ever used that term before, but it just made sense to me. I've been for a long time saying, the market's overvalued, but there's a lot of good companies that are doing well, and that's fine. So, but at some point, we got to put valuations, got to come back into this at some point. And then, of course, would they just pass the tax bill? So that's another reason to be bullish. So, okay, I'll go with it. I'm going to be reluctantly bullish. I'm going to keep that phrase for now.
Let's have a look at, say, a 10-year or 20-year for the S&P 500. It's had this unbroken ascent pretty well.
Yeah, well, I mean, when you go that long, are you talking backwards or looking forward?
Well, let's do the past 20 years for the S&P 500, because obviously, if you bought in 2009, March of 2009, you're more than happy now.
Yeah, and even if you bought in before that, and you took the big hit, but you stuck around with it, I think you've been fine. Mm-hmm. And that's probably the way the market is always going to be. I would be shocked if that ever changed. But if you can avoid those big dips like you can in 2009, you really ought to try and do that. So I think we could be coming for one in the next, it could be this year, it could be next year. Mm-hmm. We've had such a good run that it has to happen, and those taxes.
Sorry, what has to happen?
That it'll come back to, with at least 20%, if not more.
You mean the pullback of 20% will happen sometime?
Within 1 to 2 years, I would think. And I would think, too, that the tax thing sounds so great in the short run. Obviously, companies make more money. That's a good thing. But when you get ballooning deficits and interest rates look like they're going to go higher, you get that combination, and that's not great for the market. So that's going to happen.
Skeptics on these tax cuts say a lot of it will just go back into stock buybacks. So that'll help the market.
This is great for the market, right?
Yeah.
It's obviously going to help out in the short run. But in the long run, again, because it is going to hurt the deficit, and that's going to hurt the economy. So that'll come around at some point, and then when you get, the valuations keep going up, and then interest rates creep up too, all of a sudden people are going to flip the switch, and they're going to go the other way, and it's going to happen. It's got to happen within 1 to 2 years.
Okay, so I was kind of showing you that we were negative at the time. And that things were kind of as good as they get, and their valuations were high, and we were being cautious back in December. But I think we used the term reluctantly bullish, and I think that made sense at the time. Just past the fiscal stimulus tax cut policy. So, yeah, that's good for corporations, but as I'm going to say later, is why that might not be as fruitful as you may think. Okay, now I want you to watch a clip from just last week on February 2nd, 2018.
Hi, welcome to Market Call. Our guest is Matt Kaiser today. He is president of FSA Financial. We are seeing selling today. Markets, though, are still pretty near all-time highs, and stocks are not cheap.
Yes, yeah, that's certainly how I feel. I think the last time I was on was late December, and I think I said I was a reluctant bull. I really am waiting for some sort of I don't even want to say pullback. I'm hoping for a little bit more than a pullback. Kind of a washout, I would call it, I guess. Not a crash, but a little bit, let's clear the deck a little bit and go from there.
All right, let's have a look at the 10-year for the S&P 500. I mean, why is it hitting a wall, or has it been over the past couple of sessions?
Yeah, so, I mean, there are a lot of good reasons that the market is up. The economy is strong. We've had great fiscal and monetary stimulus, so, why not? It should be at a high. But at some point, you just got to say, okay, wait, enough is enough. It's priced in. We had a great January, for at least in the U.S., and we've had, I think it's 22 of the last 23 months, the market has been up, S&P 500. So, and it's harder and harder to find good ideas. And I'm a bottom-up kind of guy, so I'm not great at doing the macro, although, I follow it, of course. But what I do is I look stock by stock by stock. And when time and time again, I can't find, a really great idea, that's when I start to go, wait a second, there's market's a little rich. So, no one can predict the top, but what we look for are things like, I think in my example in my write-up was Texas Instruments.
Okay, TXN, yep.
TXN. So they, had a pretty good quarter. I think revenue was up, they beat expectations, and stock was down 9%. That to me says, hey, people are starting to go, all right, we see that the top is kind of coming. It's pretty close. And I'd love to see that. I'd love to see a pullback so I could be more confident about, my great ideas.
My comments, in fairness, we're a bit hedged. That's the nature of this business, that everyone hedges a little bit. You'll never see anyone say, outright buy and outright sell, very rarely anyways. But if you kind of read between the lines, and the sentiment is quite bearish. So, yeah, and it should always be that way, because there's always reasons why a market can go up and a market can go down, and the same with a stock. A stock can always go up, a stock can always go down. So you're really just trying to figure out, where's the balance, and if the balance is in one direction over the other, that's pretty important. And so you're going to find hedge comments, read between the lines, and figure out that whatever analyst, not just me, but any analyst, is going to be somewhat hedged in their commentary, but they're going to lean one way or the other, and that lean is really important. Okay, so this pullback now, as you've seen, I've been somewhat bearish. The pullback now, I believe that there is still more downside to the risk as opposed to time to buy in. Some of the things we talked about with why it was high, the market was high, is because of the monetary and fiscal policy that we've had for the last little while. Monetary policy has been strong since I can remember, at least back in 2009, so it's been 9 or 10 years even before that. I think monetary policy was pretty strong. Fiscal policy now, they just passed the stimulus bill, the tax bill, I shouldn't say stimulus bill, the tax bill. This all led to really high valuations, and the valuations are really hard to justify, even after this little pullback. Really, it's not that much of a pullback. If you think of January was an extraordinarily high month, and the market's given all that back. But if you eliminate the January rise and the pullback, really, we're almost flat for the year. So, and we've had a huge run for the last 8 or 9 years. So, I think the downside is still, there's more downside risk than upside potential at the moment. One thing I want to point out too is I've learned from economics many years ago when I took those courses at university that what the first step in an economic cycle is not what you need to look at. So the fiscal tax cut stimulus is the first thing you think about. But if you start to just do some of the next steps, that's where you start to go, oh, wait a second, this could be a problem. So of course, companies making more money from a tax cut is immediately a good thing to their bottom line. More profit, more cash flow, higher valuation. However, this leads to inflation. It leads to ballooning deficits. It leads to higher interest rates, which everyone is starting to already get ahead of. And that's why you're seeing such negative sentiment on the market. That everything was as perfect as it could be, and now we're already starting to think about the next wave. And the next wave can only be down. It can't, I say it can only be down. It would be really impossible to imagine. You're not going to get much more monetary stimulus. You're not going to get much more fiscal stimulus. So you start to think about the next wave. Well, the next wave can only be higher deficits. Valuations are expensive. Higher inflation. Higher interest rates. Stocks go down in that environment. So that's why we're still negative. If and when there's a bigger washout than we've already experienced, we'll be more aggressive, and we'll be right back here telling you about that. Another point I wanted to make is that trying to find the top and the bottom is definitely difficult. You'll never get it bang on, but a couple of things usually happen at both ends, and that is volatility. Volatility is highest when the market is going through a correction, or it's going to rebound, because nobody believes it, right? So you'll have people that'll do exactly, what we said. They'll buy back. Oh, buy on the dip, right? That happens, and people will do it. And the volatility is at a max, usually at a peak, and volatility is also at a max at a bottom, and you're seeing that. So I think there's still more downside risk than there is upside potential. We'll have a buy on the dip, hopefully a bigger dip than the one we have now, and we'll be right here to talk about that as well. Thank you.